I grew up here in Lancaster County, Pennsylvania, and I was born into a very entrepreneurial, business friendly family. My dad bought a modular building business the year I was born. So I started at 6 years old. I started painting hinges and kind of working around doing the little knickknack stuff around our manufacturing facility, and kind of grew up in that space. As I was growing up, I was an entrepreneur and didn't even know it, but I watched my dad buy farms and land and single family homes, and I saw him self-manage those single family homes, and I quickly made up my mind that I was never going to buy real estate. And so I built a couple businesses. I built some businesses around the modular building space, and sort of, started growing those businesses, and got to the point where, in my late 20s and early 30s, I was doing really, really well. And I started having to pay a lot of tax. And I remember, having to pay $500,000 a year in tax. And then I heard this guy, Robert Kiyosaki, talking about how you can make millions of dollars a year and pay no tax legally. And so I had to find out what that was about. That drove me crazy, because the way that I was raised and taught, and conventional wisdom tells you if you make a lot of money, you got to pay a lot of tax, right? So I went down the rabbit hole, and I was researching and reading and going to live events and jumping on webinars and educating myself in the space, and really went from paying a $500,000 a year in tax to paying zero the following year. And it really was because I realized that these guys, many of these guys that were living tax efficient or tax free, were using depreciation. They were using real estate, multifamily apartments, and some of these assets that were getting them the depreciation they need, and getting them into the tax efficient or tax free zone. So I learned quickly. They say that the quickest way to learn is when you're going through intense pleasure or intense pain. Well, mine was intense pain, and I learned quickly, and I became a student. And since that, over the last 10, 15 years, I mean, a lot of my, life, my investing and my business life now evolves around, not only how do I make a lot of money, but how do I keep the money that I earn. And when I cracked the code and started doing that for myself, I realized that there was tons of people out there that were in my same situation. And I started helping these people to become tax efficient. I started with multifamily apartment buildings. And I remember thinking back then, and this was kind of, not the smartest thing to do, but I remember thinking back then, if I could just buy buildings that would get me to the point where I can stop being a tax slave. If I can, I mean, forget the income, forget the appreciation. Like, if I could just buy buildings and start building, start adding to my asset column and get myself in the tax-free zone. That's goal number one. And then, of course, if you buy the right buildings in the right areas, you can start building, big streams of income, and you start building equity. And of course, we were buying multifamily apartment buildings in 2012 to 2019, 18, 19. And so, the wind was at our backs, and of course, if you look back now, we look like geniuses. We got a little lucky because of timing. But I mean, we bought a lot of assets, and so the first asset class that really got me to the point where, wow, this is really moving the needle and getting me into that tax-free zone, was multifamily apartment buildings. And then, of course, ATMs. I've been doing ATMs for the last 11 years, and really getting in that space. I got to, I was learning, language like cost segregation studies and bonus depreciation and kind of all that stuff. And it got to the point where I'd look at an asset class, and of course, yeah, you want to look at the income, or you want to look at the asset appreciation potential. But high on that list was, okay, what does this do for me on a tax, from the tax impact side? So that's the way we look at investment. We don't start with the tax impact side, but it's high up on the list, definitely in the top three. You grow where the pain is the lesser of, right? So you always try to get the lesser of the two evils. Now, I will tell you that I don't get out there and manage my own stuff. That's rule number one. But I saw my dad doing that by himself. I saw him self-managing. That's not how we play over here. We find best in class operators and property managers and asset managers, and we try, our ATM management team, the operations team, top 4 in the country, our self-storage asset management team, the operations team, one of the top property management teams in the country. So, one of the things I spend a lot of time is not only what asset class do I think makes sense for the next 5 to 10 years? What asset class do I want to have? What do I want to put in my portfolio? What do I think is going to do really well over the next 10 years? But once I locate that asset class, once I really nail down, okay, this is the one. I want this, for whatever reason, I want a bunch of that in my portfolio. Now my focus goes to, okay, who's going to be my operations team? Who's going to make this asset class work? And if I can find a great operator, it just becomes a whole lot more enjoyable. I've always been sort of a generalist and I've always been curious. And so I get bored rather easily. In the investment world, boring is good. And so you want investments that are boring. But I've always sort of had a curious mind, and then there's something out there that sparks my interest. Like, wait, how does that work? Like, tell me more about ATMs. Wait, are you talking like me as an individual investor? I can own a bunch of ATMs and just get paid every time somebody swipes their card? Like, tell me more about that. And then, making sure that the income is there. And then knowing that you've got 100% bonus depreciation as part of that package. And then having a world-class operations team that makes everything work so that you can be somewhat passive. I've always been curious, and so I'll tell you the story, because when I started buying multifamily apartments, I was really just doing it for myself. I didn't start out in the multifamily space thinking that I was going to be a syndicator. I just bought a couple hundred units of my own and ran out of my own money, and then I had to go raise some capital from my dad and my brothers, and then of course I had more, and so I went out to some of my business associates, my peers, and my network, and I told them the story, and of course they wanted to play, and so I sort of just kind of fell into the syndication world. So sort of just the trajectory that I was just going along and doing my thing, and it made sense. But then I looked, at the same time I was investing in ATM machines myself personally. And when I first got approached by my operations team about taking this out to my investor group, because they were watching me on the multifamily space, they were saying, well, wait a minute, why don't you take this out to your investors? I'm like, you can't syndicate ATMs. Nobody syndicates ATMs. Like, the only syndicators I knew back in the day, 10, 12 years ago, was multifamily guys. And that's what everybody was saying. Occasionally you'd have a self-storage guy or something like that, but most of your syndicators were multifamily guys. So I was like, can't syndicate ATM. Nobody does that. But at one point I said to myself, I'm like, wait a minute, this is one of my favorite investments. This works for me. And it goes along right with what we teach, about being tax efficient, about building your wealth, about building your income streams. Like, why wouldn't it work for my investors? So I took it out to my investors, and there was immediate interest, and like, okay, that worked. And number of years later, we're top 4 in the space, and we've really scaled that business. I invest in a whole lot of different stuff, and many times I'll invest in something to sort of dip my toe in the water and just see what can I learn here. Do I like this asset class? Do I want to do more of this? Do I like this operations team? Do I want to, and so I'll invest my own money and kind of go in small and just kind of tinker around with it, and I'll see if I really like it. If it has a couple of those characteristics, like I was talking about: income, capital appreciation, depreciation, tax impact. What does that look like? And so I'm curious. At the end of the day, what are we trying to do here? We're trying to build wealth, right? Back then, looking at an income stream that came from an ATM made all kinds of sense. I was a serial entrepreneur. I'm also a serial investor. I built a lot of businesses. I invested a lot of stuff. I may invest in 10 different things, and maybe a couple of those 10 different things are too small to scale. Maybe I'm just dipping my toe in the water and trying it out. And then there may be one or two that, well, this is an asset class that I really like. This is an operations team that I really like. Can we scale this? And if the answer is yes, then I'll take it to my team. But normally it's after I put my own money at risk for a while and really went in with my own capital and tried to make sure that this is an asset class that I want to take to my investors, an operations team that I trust and believe in, that I believe that will deliver a bunch of success for our investors. It's different. In the ATM space, the sponsor came to me with the ATM through a friend. And so he came to me with the ATMs. Normally, I sort of pick out the asset class and then go find the sponsor. In the self-storage space, I'll give you an example. Well, in the ATM space, the sponsor came to me. There was an introduction through a friend. The sponsor came to me, had the ATM, showed me their track record, showed me what they were doing, and I invested with them. Invested whatever, 100 grand. And, a year later, I invested another 100 grand, a couple hundred grand, whatever, and started building a position of my own. And after I had built a 7-figure position, then I took it, after 3 or 4 years, I took it out to my investor group. In the self-storage space, that was a little bit different. I was interested in the self-storage space for the last 20 years. And, I knew about it through my research. I realized that, coming out of 2008 to 2010, of course, I was watching different asset classes, and I recognized that they were the best performing commercial real estate asset class. They got least affected by the downturn in 2008, and they were the quickest to rebound, and they were the best performing asset classes of all of their commercial real estate asset peers, or of their commercial real estate peers, from 2008 to 2010. I was like, that's really interesting. How cool would it be to have an asset class in your portfolio that does really well when times are good, and it does even better when times are bad? And so it sort of acts like a little hedge in your portfolio. And so that I found really interesting. So I found that asset class, and then I went and searched for the operator. And of course, you could go on Google and try and find an operator, but that's not, I wouldn't recommend it. To me, I'm pretty connected in the investment community. And, this is a pretty small group. There's a pretty small group of us. And when you hear a name in the investor community, and you got a lot of investors who say nice things about an operator, catches your attention, because any slick sales guy can talk you into and tell you how great he is. But what catches my attention is when other people tell me how great this group is. And so I did some research and really kind of dug down and found this group that I've been hearing all kinds of nice things about over the previous year or two, and did my own research and ended up going with them, and it's been a great experience. I had an investor in actually, it started with a longtime friend and mentor of mine who asked me to look over his son-in-law's shoulder. They were starting this new business. And so I looked at it and I was like, wow, this cash flows look really good. And it was a Tommy's Express car wash that they were building here locally to me. And so, of course, I looked at it. It was interesting. The cash flows look great. Of course, the depreciation is amazing. And so, I looked at it and I was like, yeah, that's cool. But, I had a lot of other things going. I couldn't get involved at the time. And so I sort of shelved it. And a couple weeks later, I had an investor from Kansas who I knew was in the car wash business, but I didn't know what brand he was operating under. I didn't know any of that. And I said, hey, did you ever hear of Tommy's Express Car Wash? Because we were talking about he called me about something else and we were having this conversation. I said, hey, by the way, did you ever hear of Tommy's Express Car Wash? And he got all excited. He was like, well, yeah, that's my car wash. I just built a brand new Tommy's Express car wash. I'm like, really? And they spent the next 20 minutes telling me how Tommy's was the greatest thing on planet Earth, and how their system works, and how they were the absolute best in the car wash space. And I was like, okay. So then I shelved it again. And a couple weeks after that, another investor from the Midwest reached out to me and said, "Hey, my son-in-law is starting this business. Would you mind, kind of taking a look at their business plan and seeing what you think?" And I was like, "Sure, I'll do it for you. What is it?" And it was like Tommy's Express Car Wash. I'm like, "Really?" Like I never heard of Tommy's Express Car Wash before in my life, and now that's all I'm hearing is these people that started. So I called my friend and mentor and said, "Hey, your son-in-law is doing a thing, doing car with Tommy's Express Car Wash. These guys are doing coming. Why don't you jump on a call with me and we'll see if their stories line up and maybe you'll learn something." Whatever. I was doing it more as something for him, and so we jumped on a call and we were on the call for 30 to 45 minutes, and we got off the call and called each other and were like, wow, this guy's really interesting. I mean, these guys are all about it and they're going after it. And so anyway, we after a couple more phone conversations, they already had private equity lined up to be their partners, their financial partners, and we convinced them to drop their PE firm and team up with us. There is nothing super complicated about what we do. You hear some of these wealth managers talking about, setting up different entities, and you got your offshore trust and you got your thing, it's moving money around. It's none of that. It's all about investing in asset classes that the government rewards you with tax impact, tax incentives, depreciation. And here's something interesting. So car washes and gas stations are unique in that they're the only businesses that I know of in the country that you can take the building and write it off at the same speed as you can the equipment inside the building. So you can take 100% bonus depreciation, not only on the equipment inside the building, but you can take the whole building. You don't have to do a cost seg study or accelerate depreciation. You can take the whole building, the equipment, everything. You can take 100% bonus depreciation. So really what that means is, let's say you invest $100,000, and let's say you're making whatever $400,000. Let's say you're on the top side of the tax bracket. You're gonna pay 40%, unless you live in California, you pay even a lot more. But let's say where I live, you're gonna pay 40%, of the top tax rate. So let's say you make 400 grand, and let's say you invest 200 grand in something that gives you 100% bonus depreciation. Well, you just wiped out 200% or $200,000 of income that you now don't have to pay tax on. So that does two things. One, you now don't have to pay tax on that $200,000. But the other thing is, you took off the top 200,000, or the kind of the money that you're going to pay 40% on, and then down to 30%. Now you're in a position where you might drop your tax bracket down to whatever, 20% or 15%, and in my case, low single digits or zero. So it's using depreciation on assets that you're investing in, and getting yourself to the point where you're tax efficient. I always tell somebody like that, you should always be building your passive income column. Doesn't matter if you're a doctor, attorney, CPA, whatever. If you're all of your income comes from you actively working, called ordinary income, you need to start working on your passive income column. You want to start building that passive income column because that's the easiest income to protect. On the other side of that, and when you look at my core asset classes that I personally invest in, which is basically the funds that we have, because of, the funds that we put out there are just a reflection of my own portfolio. So one of those is oil and gas. So we're big fans of natural gas. We drill natural gas wells with a family out of Pittsburgh who's been in the business for the last 50, 60 years. Um, so we teamed up with this family. I started investing my own money with them about 5 years ago, and have been investing with them every year since. I put a fund together to invest with them 3 years ago, and we've been raising capital and putting funds together with them ever since. But that is different. You can take, and everybody's situation is different. You got somebody that has a lot of passive income. You got somebody that's selling a business. You got a liquidity event. All those things will get you. You're going to get taxed on that, right? So in the situation where you got a doctor, a lawyer, a CPA, you got a high paid professional making $400,000 or $500,000 a year, then that could be a vehicle. You can invest in oil and gas, active drilling wells. You can come in as a GP, and this is very standard in the oil and gas space. And you can take the depreciation on that investment. You can wipe out the tax liability on your ordinary income. That is far and away the biggest one. That's the primary way we keep ourselves tax efficient. But there's some other stuff. I mean, there's captive insurance is a vehicle that we use not only for the insurance, but for the tax protection, the tax friendly. When you can create an insurance company of your own, and you fund that insurance company now as an expense to your company, and then you can keep the float. You can keep that insurance premium in there. Now you can borrow out of that account, and you can use that money to go invest in something else. We use captive insurance in several of our companies, and it's a huge tax play for us. So there's a number of different things, but primarily we're using depreciation. We're investing in assets that are giving us depreciation to keep ourselves tax efficient. I've got a very good tax strategist and CPA on my team. And we're having conversations constantly. If there's changes, I mean, right now, I don't know if your listeners are aware, but the 100% bonus depreciation rule just got passed in the House like a week and a half ago. So it got passed in the House. Now it needs to go past, get passed in the Senate and then get signed into law. But the first step got passed. So we're keeping track of that. We know. I mean, I knew like 2 minutes after it was passed, I knew that it was passed. And the other thing is I've been in this space long enough that I can help my investors through almost all of their tax issues, and come up with some strategic ideas and thoughts, and kind of help them walk through their potential tax issues. Because I've been doing it so long, and I'm surrounded with really, really smart people, a lot smarter than I am. And so the other thing I do a lot is, let's say you're coming to me and saying, hey, I'm selling my business, and I'm selling my business for whatever, $3 million, and I'm going to have a tax situation. In those situations, because there's so many nuances, there's so many different ways. Okay, how's the entity set up? Is it a stock sale? Is it an asset sale? Well, there's so many different things that can come into play. So many times in those situations, I'll have my CPA jump on the call with us, and I don't just connect, my CPA and tax strategist and my investor. I'm always on that call. Why am I on that call? Because I learn something every time. When you're around great minds and you're working through complex issues, I want to be in the room. And, every time I do that, I learn. So I'm intentionally putting myself in that room so that, I get sharper. And so every time I do that, I come away from that a little bit smarter. And, so it's just, I've been doing this for 10 years, 11 years. So it starts to become who you are. And of course, questions come up, and then you got to go research it and you get the answer, and you got to tap into your professionals, you got to tap into your team, and you just learn stuff. Spending too much energy on the deal and the potential returns, and not enough of energy and time and effort on the people. I almost every time when a deal hasn't gone well for me, it's because I've invested with the wrong people. People, this investing, this business thing, this is a people game. If you can invest, if you have the right people on your team, they can take a mediocre deal, and some of the things you just can't control. I mean, stuff happens. Like, stuff happens in the, out there in the economy, out there in the world. Cost of capital doubles in a year and a half. Well, okay, I didn't have that baked into the cake. But if you have a really good team, they'll figure stuff out. Like they can take a deal that could potentially go sideways, and you can do okay with it. If you're dealing with the wrong team, they'll take a great asset and turn it into a disaster. So I pay a lot of attention to the teams and the people that I'm around, and the people that I do business and that I invest with. I used to get really excited about, the paper, what was on the paper. Oh my goodness, this deal pencils, and this deal gets a 20% return, and this deal, whatever. It really doesn't matter anymore. To me, it's about, do I want to do business with this team? At some point, at some times, I'm with a group of people or a team where I really don't care what they're doing. I just want to be a part of it. I don't care if they're selling racing pigeons. They're so good at what they're doing, and they're such high quality people. I just want to be a part of whatever they're doing. And so I see people making the same mistakes that I made at first, like where they're so invested in the deal, so interested in what's on paper. Anybody can put stuff on an Excel spreadsheet and make it look really good. But I'd say, focus on the team. I see a lot of people still making those mistakes. And I would say if you get with the right teams, not only is your investing journey going to be a lot more fun, a lot more stress-free, but it's also going to get you the bigger returns over a longer period of time. I've been an investor all of my adult life. I just started really getting, really raising capital and syndicating deals and bringing investors in and really scaling these projects in the last 10 to 12 years. But before that, I've been an investor all my adult life. In these kind of times, when there's trouble, when there's distress in the market, when there's stuff going on, these are the kind of times where millionaires are made, billionaires are made. This is the time where if you can make smart business and investing decisions in these kind of times, this is the kind of time when you can really make it. At the end of the day, it really doesn't matter what the interest rate is. Everybody's saying, "Oh, the interest rate's up," whatever. It doesn't matter what the interest rate is. The deal has to work. It doesn't matter if the interest rates are 5% or 10% or 20%. If the deal works, at the end of the day, the deal has to work with that specific scenario. So, we're in a situation where we're getting ready to sell 19 of our self-storage facilities. These are big institutional grade self-storage facilities. This is our second roll up in 2.5 years. And we're selling 19 of our properties. And one of the things you could ask the question, well, wait a minute, why not, why sell now? This is not the best time to sell. But we're looking at it saying, okay, wait a minute, we can make, we've got interest rates. Our fixed rate debt is starting to expire by the end of next year and then into 25. So we can sell now and then have capital to redeploy in this market where those deals are starting to make sense at a 7%, 8% interest rate. So it's about taking a situation that, look, if we take our portfolio that on average is, we've got 3.8% money, and we refinance into a 7% market, it's going to kill our cash flow. Yeah, we could ride that into the next cycle, and we'd be fine. We build enough of equity into the deal, we'd be fine. But we just feel like if you can make a deal work in today's market, and there's opportunities showing up now, and I believe there'll be even more so later on this year and next year, for the same reason I just shared with you. You got fixed rate debt expiring, you got bridge debt, that's a problem. You got all these problems in the marketplace, and you know problems is when you make the most money, when you go out and solve problems.